you just kind of addressed a bunch of like specific situations around inflation, and there's another thing. The definition of inflation is so wide varying, right? Like what is inflation? I know, Adam, you've written a bit on this, but like what are the different types of inflation that we mean when we mean inflation?
Well, yeah. So there's sort of supply shock inflation where something happens. Think about the oil embargo and the Iranian Revolution in the 70s, obviously restricting the flow of oil, and therefore the price of oil skyrocketed and triggered broad price increases through the economy because virtually everything that's manufactured requires energy. So that's kind of the traditional supply end. Then there's demand side, which is we're sort of seeing some of that today in combination with supply-led inflation, right? You have a major shock upward in aggregate demand as a function of governments expanding very sizable deficits. Again, like Mike said, we had major deficit spending during wartime. I want to say 4 years in a row of 15% or higher deficits as a percent of GDP during wartime. The last couple of years, we've seen 12, 13% of GDP in deficit spending. So that just leads to a major demand shock, and in combination with a little supply, that leads to too much money chasing too little production and a rise in the price level. And then there's monetary inflation, where governments devalue their currency by directly printing more money into the system, and other countries lose faith in the purchasing power of that currency, and they begin to sell it. And the people that are in the economy begin to move away from using the country's unit of currency and start denominating trade in the currency of other countries or barter, that sort of thing, right? And I know, as we'll talk about, there are different asset class reaction functions to each of those different types of inflation. So there's no single portfolio panacea that solves the problem of all types of inflation.
That's right. You need a broad swath of opportunities as you look through history, how each inflationary cycle manifested and changed. Even the 70s saw several different types of inflation manifest during that sort of very, very memorable stagflationary time period. And within that longer time period, there was actually lots going on where oil didn't do so well for a while, but other forms of inflationary hedges did. And so it behooves asset allocators and investors to really think that through, because you don't want to. You want to buy an inflation hedge, and I see in the comments some folks talking about gold and tips haven't really kind of worked over this period, and there's just different things that are at play in the asset models. Go ahead.
Well, which period, right? So gold actually worked pretty well from the bottom of the commodity of the COVID crisis to the end of the year, because rates went from being relatively positive to negative, right? So that gold tends to do well when real rates are going to the downside. That happened. That was a phase of inflation. Then came lumber. Then came energies. Right. So over the last 2 years, we've seen inflation manifest through different commodities. Tips is an interesting one, because everything I'm reading about tips and what we've seen in terms of inflationary regime, they really don't do anything but just keep your purchasing power. They don't do anything outside real returns. Right. So that's his job. That's what it's designed to do, as an offset to your portfolio, to the things that are losing money in real terms. It may not be great. And so, we gotta, as we go through the data and what has done well in the past, I think we have to be cognizant of the fact that what has done best in the past as like the number one inflation hedge may not be what is going to do best in the future. So do we want to kind of bring up those asset classes first, or do we want to talk about kind of the framework?